Hello, champions. It's finally the day of the examination. You might still be having syllabus left. You might still be having concepts left. You might still be having some targets which you've not met yet. It's fine. Let's be content with how much we've been able to cover in these last 2.5 days. Let's be content, guys, because this preparation is enough. It will help us sail through the examination. This is enough. We have done more than what was required. We have done more than enough. We are only manifesting success for ourselves today. Close your eyes for a moment and imagine you look at the question paper at 1:45 and you get this feeling that yes, I know this, I know this. This question is very familiar. I've seen this before. Just imagine that initial positivity which you're going to feel at 1:45. With that positivity, with that ray of hope in the beginning at 1:45, you will be able to so comfortably sail through your entire 3 hours, guys. That is exactly what we're manifesting. That is the kind of success that we deserve. That is the kind of happiness we deserve because we have worked so hard in these last 2.5 days. Now, this video is really, really crucial. Why? On the day of your exam, I'm taking 1 hour of yours. So every little thing I'm going to squeeze in into this video is a non-negotiable in capital letters. These are 50 concepts, guys, 50 reminders that I want to give you just before you walk into the examination hall. 50 crucial concepts which you will find somewhere or the other in your question paper, either in the MCQs or in the descriptive part, somewhere or the other. So we will spend around an hour, guys, doing all of these 50 concepts as nicely as possible, okay? But I'll tell you what the problem will be. The problem will be that many of you will say that, ma'am, actually we did not keep that 1 hour buffer for today, to spend time on a video like this on YouTube. Let me tell you, you would have kept 1 hour for today to do the RTP and the MTP of your September exam, right, guys? Instead of doing that, you will be watching this video, because through this video not only will the 50 concepts get revised for you, but also every little learning which you have in the RTP and the MTP of September exam, even that will get covered because I have incorporated them as well in this list of 50 points, okay? So it will be like the best of both worlds. Your 50 important concepts will also get revised for you, and your RTP and MTP of your September exam will also get covered for you. All right, so come on, guys, let's begin straight away. I've arranged them chapter wise, so we'll go from the very beginning, one after the other, okay? My very first discussion is from basics and kinds of companies. Now, here my first point is about listed and unlisted companies. I am talking to you about 3 companies over here. These 3 companies have listed some security in the stock exchange, but still they will be considered as unlisted companies. Number 1, guys, we have public companies. Public companies which have not listed equity shares in a recognized stock exchange. They have not listed equity shares, guys, but they have listed either non-convertible debentures, or they have listed non-convertible preference shares, or they have listed both, issued on a private placement basis. So this company, even though it has listed some security, it will be considered as if it is an unlisted company. What kind of a company? Public company. What it has not listed, it has not listed equity shares, but what it has listed, either non-convertible debentures or non-convertible preference shares, or both, issued on what basis? Private placement basis. So even though something is listed, I will treat it as if it is an unlisted company. Point number 1. Then comes point number 2. Again, it's a public company, okay? Again, same thing. It has not listed equity shares in a recognized stock exchange, but it has listed equity shares in a stock exchange in a jurisdiction specified in section 23 subsection 3. In simple words, guys, it's a public company. It has not listed equity shares in a recognized stock exchange in India, but it has listed equity shares in a stock exchange outside India. Like, for example, it has listed equity shares in New York Stock Exchange. So these kind of companies, they have listed some securities, okay, not in the Indian stock exchange. They have listed in the foreign stock exchange. Something they have listed, but still, even these companies will be considered as if they are unlisted companies. And lastly, private companies which have listed non-convertible debentures issued on a private placement basis. Again, same thing, guys. Even though the company has listed something, even though the company has listed some non-convertible debentures, still this company will be considered as if it is an unlisted company. So we are talking about 3 companies over here. Even though something they have listed, we are still going to consider them as if they are unlisted companies. Okay, guys. Point number 1 and 2 is regarding public companies. Point number 3 is about private companies. Alright, in this the most important point is this. I hope you understood this, guys. It's a public company. It has not listed equity shares in a recognized stock exchange, but it has listed equity shares in a stock exchange mentioned in section 23 subsection 3. This is nothing but foreign stock exchange. Simple. Okay, then comes, so this is my concept number 1. Then comes the second concept. Here we're talking about subsidiary companies holding shares in holding companies. Section 19, guys, very important section. We know very well that a subsidiary company cannot hold shares in the holding company. So if once a holding subsidiary relationship is formed, after that, if the holding company allots any shares to the subsidiary company, that allotment will become void. The subsidiary company cannot hold shares in a holding company. If the holding company allots shares to subsidiary company, that allotment will become void. However, there are 3 exceptional cases, guys, wherein the subsidiary company can hold shares in holding company. That is what is mentioned in section 19. Situation number 1, when the subsidiary company is holding shares of the holding company as a legal representative of a deceased member. So subsidiary company can hold shares in the holding company as a legal representative. As a legal representative of the deceased member, subsidiary company can hold shares in the holding company, allowed. Then subsidiary company can hold shares in the holding company as a trustee. Even that is allowed. And point number 3, even before the holding subsidiary relationship could be created, even before that, the subsidiary was holding some shares in the holding company. Those shares the subsidiary can continue to hold, they can continue to own, no problem. So 3 points, guys. Point number 1, once holding subsidiary relationship is formed, after that, if the holding company allots any shares to the subsidiary company, that allotment will be void. But however, there are 3 cases where subsidiary company can hold shares in the holding company. Number 1, as a legal representative of a deceased member. Number 2, as a trustee. And number 3, the shares which subsidiary company was holding in the holding company, even before the holding subsidiary relationship was formed, those shares the subsidiary company can continue to hold in the holding company, no problem. Okay, 2 points done already. Then comes my third point, very, very important again. Favorite question of the examiner, guys, small company. So small company means a company paid up share capital of which does not exceed 4 crore rupees, turnover of which does not exceed 40 crore rupees. So the paid up share capital has to be within 4 crores and the turnover has to be within 40 crores. Okay, we have some more numbers as well, but the effective numbers are 4 crores and 40 crores. So the paid up share capital has to be within 4 crores, turnover has to be within 40 crores. However, the most important point over here, numbers everybody will be able to remember. This is the part which we might tend to forget in the examination, and that is why few hours before the examination I want to remind you about this. There are 4 kinds of companies which, even if they fulfill these criteria, still they will not be considered as small companies. Number 1, public company. Number 2, holding company, subsidiary company. Number 3, section 8 companies. And number 4, statutory companies. These companies, even if they fulfill this criteria, still they will never be considered as small company. That is why I always tell students, whenever you get a question about small company, think about the criteria later. First check if any of this is involved, only then come to the criteria. Understanding? The company should not be a public company, should not be a holding company, should not be a subsidiary company, should not be a section 8 company, should not be a statutory company. Only if the company is none of these, only then you will check the criteria. Paid up share capital should be within 4 crores and turnover has to be within 40 crores. Okay, then listen, some important points from the prospectus chapter now. Extremely important, listen to me, private placement. See, in a year, per security, the company can make the private placement offer to maximum how many people? To maximum 200 people. The act says 50% or such other number as may be prescribed. And the rules have prescribed the 200 number. So effective number is 200. Okay. So in a year, per financial year, per security, the company can make private placement offer to how many people? Maximum 200 people. Okay. What if the company makes a private placement offer to more than 200 people? What will happen? Then we will treat it as if it is a public offer. It will be deemed to be a public offer. We will treat it as if it is a public offer. Okay. But listen, however, when you're counting this 200 persons, no, when you're checking company has given the offer to how many people during the year, when you're counting that limit, please do not consider QIB, qualified institutional buyers. Do not consider employees to whom we are giving ESOPs. So in simple words, it will be like this. We will see the company has made private placement offer to how many people. Okay. From that, we will subtract the the qualified institutional buyers. We will subtract the employees to whom the company is offering ESOPs. We will see the balance number. This balance number should be not more than 200. Now understood, guys? So per financial year, per security, the company can make the private placement offer to maximum 200 people only. Now if the company makes a private placement offer to more than 200 people, it will become a public offer. So what if it becomes a public offer? Big thing, guys. SEBI rules and regulations will start applying. Okay, then when you're counting this 200 persons, when you're checking company has made the private placement offer to how many people, when you're checking that, you will not consider 2 people, guys. You will not consider qualified institutional buyers. You will not consider employees to whom the company is giving ESOPs. The balance number of persons should not be more than 200. Okay, simple. Then comes another important point from your prospectus chapter, misstatement in prospectus. See, let us say there's a company. This company has issued a misleading prospectus. Now there's this person, Mr. Red. He relied on that misleading prospectus. Relying on that misleading prospectus, he subscribed to the company's shares. Then because of the misleading prospectus, because of purchasing these shares, he has suffered some loss or he has suffered some damage. This loss or damage, he can ask for compensation, guys. You know this very well. So what are the conditions now? The conditions are that number 1, he must be a subscriber, which means he must have bought the shares directly from the company. He should not have gotten these shares from the secondary market. He should have subscribed to the shares, not purchased the shares. He should have subscribed to the shares. Point number 1. Point number 2, he must have subscribed to the shares relying upon the misleading prospectus. Point number 3, because of this entire transaction, he should have suffered a loss or a damage. So only if all these conditions are fulfilled, only then he can ask for compensation. Only then he can ask for damages. Okay, so which means if he has not suffered a loss or a damage, if he has not suffered a loss or a damage, even if there is a misleading prospectus, but if he has not suffered a loss or a damage, he cannot ask for any compensation. He will not have any remedy. He will have compensation. He will have the right to receive compensation. He will have remedies only and only if 3 conditions are fulfilled. Condition number 1, he has subscribed to the securities on the basis of a misleading prospectus, and condition number 2, he has suffered a loss or a damage because of this transaction. Only then he can ask for compensation. Only then he can ask for remedies. Okay, this was your 5th point. Then comes your next point, guys, from your share capital chapter, premium. See, first of all, you know very well that can a company issue shares at a discount? See, at a discount, equity shares, preference shares, prohibited, not allowed. But bonds and debentures, yes, they can be issued at a discount. Remember, the prohibition is only on shares. Okay. So, but anyways, our focus now is on securities premium. So, securities premium money is not free reserves of the company. The company cannot use this money for whatever it wants. It cannot use this money for general business purpose. Securities premium, whatever money the company has over here inside this account, it can be used only and only for 5 purposes. What are the 5 purposes? Number 1, it can be used to issue fully paid bonus shares. Number 2, to write off preliminary expenses. Number 3, to write off the share issue expenses or debenture issue expenses, underwriting commission, discount on the issue of debentures and all. So to write off all of this, you can use a securities premium money. Then we can use a securities premium money to pay the premium on redemption of preference shares and debentures. See, when we are redeeming the preference shares and debentures, for the entire redemption amount, we can't use a securities premium. Only the premium on redemption, that alone we can take from securities premium account. And lastly, we can make use of securities premium money for buyback of shares. So point number 1, securities premium money cannot be used by the company for general business purposes. Cannot be used for general business purposes. It can be used only for 5 purposes. Number 1, to issue fully paid bonus shares. Number 2, to write off preliminary expenses. Number 3, to write off share issue expenses or debenture issue expenses or underwriting commission or discount on the issue of debentures and all. Then number 4, it can be utilized to pay a premium on redemption of preference shares and debentures. See, you cannot write that securities premium can be used for redemption of preference shares and debentures. You can't write. It can be used only for the premium on redemption of preference shares and debentures. Okay, basically only the premium portion alone you can take from the securities premium account. And lastly, we can use the money in this account for buyback of shares also. Okay, but however, if the company happens to be if the company happens to belong to a prescribed class of companies whose financials have to be as per accounting standards prescribed under section 133, that is Ind AS companies, those companies can use the securities premium money only for 3 purposes. Which 3 purposes? The first purpose, that is to issue fully paid bonus shares. The second is to write off the share issue expenses, debenture issue expenses and all. And lastly, for buyback of securities. So generally companies can use securities premium money for 5 purposes. But if you're a company which belongs to this prescribed class of companies, then those companies can use the money in the securities premium account only for 3 purposes. Okay. Then listen to my next point, my 7th point, issue of equity shares with differential rights. You know very well that a company can issue these equity shares with differential rights where the voting right or the dividend right is slightly different, guys. It can be more or it can be less. Generally, one share has one vote, but these kind of shares may have lesser voting right, like one share is having only half a vote, or it can have more voting right, like one share is having 1.5 votes, but just that it is having little different rights. Okay, but the maximum voting power that these kind of shares can enjoy is maximum 74% of the total voting power. This point everybody knows, but there's a very important point over here which I wanted to remind you about, and that is, in case a company has made any default with respect to 5 things. Number 1, any default with respect to repayment of term loan, or any default with respect to payment of interest on this term loan. Loan from whom? A public financial institution or a state financial institution or from a scheduled bank. So if a company has taken a loan from any of these and has not repaid, default number 1. Or if the company has not properly paid interest on this loan, default number 2. Or if the company has not properly paid statutory payments relating to employees, like for example bonus to the employees or gratuity to the employees, if there's a default in that. Or if the company has not properly credited money to IEPF, or if the company has made any default with respect to payment of preference dividend. In case a company has committed any of these defaults, guys, then the company cannot issue equity shares with differential rights. Okay, so now what happens? Listen, company, you have committed a default. Now you can't issue equity shares with differential rights. You first rectify the default. Let us say the default was rectified on the 1st of January 2020. Now, you can't immediately issue these shares. You still have to wait. We will see in which year you rectified. You rectified in financial year 1920. We will see what is the end of this year. End of this year is 31st March 2020. To this we will add 5 years. So 31st March 2025. So company, till 31st March 2025 you have to wait. Till this date you can't issue equity shares with differential rights. Understanding? Only after this only you can issue equity shares with differential rights. So the point that I'm trying to convey to you is this 5 years calculation is from when? It is not from the date of default. It is not from the date of rectification. It is from the end of the year of rectification. It is not from the date of default. It is not from the date of rectification. It is from the end of the year of rectification, end of the financial year in which the default was rectified. Understanding? Then comes my 8th point with respect to transfer of partly paid up shares. Very important point, guys. Listen to me very carefully. Let us say there is this person, Mr. Red. He wants to sell away his shares to this person, Mr. Blue. So Red becomes a transferor and Blue becomes a transferee, guys. And those shares happen to be partly paid up shares. Okay, listen to me very carefully. Whenever there is a transfer, whatever kind of shares doesn't matter. Whenever there is a transfer of shares, in those cases, the transferor or the transferee, any one of them has to submit instrument of transfer to the company. Now think from the company's point of view. Company has received an instrument of transfer. Company has received it from the transferor, not from the transferee. Company has received it from the transferor. If the company is receiving it from transferee, this process itself will not apply. So what is my situation? My situation is company has received instrument of transfer from whom? From the transferor, condition number 1. And condition number 2, what kind of shares are going to be transferred? Partly paid up shares, condition number 2. So think from the company's point of view. If the company has received an instrument of transfer from the transferor, and condition number 2, this instrument of transfer is for the transfer of partly paid up shares, then full drama only. What drama? 3 steps. Step number 1, the company will give a notice to the transferee telling the transferee, hey, are you aware that these are partly paid up shares and hence the liability of the unpaid amount will be on you only. Then comes step number 2, the transferee has to give a no objection to the company within 2 weeks from the receipt of the notice. Step number 3, only then the company will register the transfer. Understanding? So when will this whole situation apply? When will this whole drama apply? Only if 2 conditions are fulfilled. Condition number 1, the company has received the instrument of transfer from whom? From the transferor. And condition number 2, this whole process, this whole transfer is for what kind of shares? For partly paid up shares. Only then the company will do these 3 extra steps. The first extra step, company will send a notice to the transferee telling the transferee, hey, are you aware that these are partly paid up shares? Step number 2, the transferee has to send a no objection to the company within 2 weeks. 2 weeks, guys, important time limit 14 days. 2 weeks. Within 2 weeks, the transferee has to send a no objection to the company. Only then the company will register the transfer. Okay, but this whole process will not apply if they are fully paid up shares. Also, this process will not apply if the instrument of transfer was submitted by the transferee. Then also this process will not apply. Okay, then I have 4 important points with respect to buyback, guys. Point number 1, maximum how much amount can the company spend on buyback? 25% of paid up share capital plus free reserves plus securities premium. Point number 2, maximum how many equity shares can the company buy back? 25% of the total paid up equity share capital. Here be careful, if the company is buying back within 10% of the paid up equity share capital, then in that case board resolution only is required. But if the company is buying back more than 10%, but maximum the company can buy back only 25% of paid up equity share capital, in that case company will require a special resolution. Okay, then the debt equity ratio after buyback, post buyback debt equity ratio should not be more than 2, it should be less than or equal to 2. And then lastly, another important point, guys, once a company buys back shares, if the company again wants to buy back, it has to wait for 1 year. So the time gap between 2 buybacks should be minimum 1 year. Then you also have one more point over here, you have the 6 months cooling period concept also, which says that once a company buys back securities, the company has to wait for 6 months. In these 6 months, a company cannot make a further issue of the same kind of securities. Basically, in these 6 months, company can issue other kind of securities, no problem. Company can issue bonus shares, company can do conversion of preference shares into equity, conversion of debentures into equity, all that the company can do. But during these 6 months, right after buyback, the company cannot make a further issue of the same kind of securities and raise money, not allowed. 6 months cooling period is applicable. Okay. Then one last point in the share capital chapter relating to sweat equity shares. There are 2 things I want to discuss with you with respect to sweat equity shares, guys. One is a limit and the other is lock-in period. Let's talk about lock-in period first. Now, when it comes to this lock-in period, let us compare 2 things. Let us compare sweat equity shares also and ESOPs also. Okay, so for sweat equity shares, the lock-in period is 3 years, guys, which means once a company allots a sweat equity shares to you, for 3 years, you cannot transfer the shares. Simple, guys. In ESOPs, the lock-in period is not mentioned in the act. The company will decide what the lock-in period is. The Companies Act has not specified any number. Okay, but however, when it comes to ESOPs, the Companies Act has prescribed a vesting period. The vesting period has to be minimum 1 year. Vesting period concept is not applicable for sweat equity shares. So understanding there are 2 words, lock-in period and vesting period. In sweat equity shares, the lock-in period is minimum 3 years. In ESOPs, the vesting period is minimum 1 year. Okay, so this was one point about lock-in period and vesting period. Now, the most important point with respect to sweat equity shares that I want to give you a revision on is this limit, guys. What is the maximum limit that the company can issue sweat equity shares? 2 maximum limits we have, guys. One is a per annum limit and the other is total limit or overall limit. So per annum limit is 15% of the existing paid up equity share capital or 5 crores issue value, whichever is higher. Okay, doesn't matter what kind of company, for every company same limit only, 15% of the existing paid up equity share capital or issue value 5 crores, whichever is higher. Then we have an overall limit also. Overall limit, it depends upon what kind of a company. Is it a startup company or any other company? In startup companies, overall limit is 50% of the paid up equity share capital. In other companies, it is 25% of paid up equity share capital. So totally 3 percentages we have over here, guys. Be careful. Per annum maximum is 15% of paid up equity share capital. So per annum limit is 15%. Overall limit for startups is 50% and for other companies 25%. Okay. Then listen to my next point about deposits. See, once I explain this to you, you will understand on your own that why exactly I have even brought this point for the day of the examination revision. Listen to me, okay? See, let's say there's a company. This company has done a default. What default? Either a default with respect to repayment of deposits. It has not repaid the deposits on time, or it is not paying the interest on deposits properly. Okay. So if the company already has some default with respect to deposits, then in that case, company cannot accept more deposits. It can't accept. Okay. So what the company has to do is 3 things. First, the company will have to rectify the default. It will have to make good the default. Then the company will have to wait for 5 years. Then the company will have to to get an auditor certificate confirming that yes, the default has been rectified and 5 years are over. Only then the company can accept subsequent deposits. Understanding? So if the company has done any default with respect to repayment of deposits or interest on deposits, then in that case, while the default is existing, the company cannot accept more deposits. Company, wait. First you rectify the default. Then you wait for 5 years. Then you get auditor certificate confirming that default has been rectified and 5 years are over. Only then you can accept more deposits. Now, are you noticing? Did you identify for yourself why exactly have I brought in this point? Even here we have default. Even here we have some default. Even equity shares with differential rights. Even here we had some default. Even over here we said company wait for 5 years. Even here we are saying company wait for 5 years. But in equity shares with differential rights, we're telling the company to wait for 5 years from the end of the financial year in which the default was rectified. But here we're asking the company to wait for 5 years from the date of rectifying the default. So it's a tiny point, guys, but may make a big difference in your examination. I'll put it for you once again over here, okay? Listen to me. When it comes to equity shares with differential rights, company has done any of the 5 defaults, guys. So in that case, we will tell the company that if you are doing these 5 defaults, you can't issue equity shares with differential rights. You have to first rectify the default, then you have to wait for 5 years. 5 years from when? We will see what is the end of the financial year in which the default was rectified. From this date, we will ask the company to wait for 5 years. Only then the company can issue equity shares with differential rates. Okay. But when it comes to deposits, we're talking about 2 defaults over here. Default number 1, the company is not repaying the deposits on time. Or default number 2, the company did not pay the interest on the deposits. Okay. So if the company has committed any of these 2 defaults, then the company cannot accept more deposits. So we will tell the company, you first rectify the default. After that, wait for 5 years. So we will not see end of the year of rectification. We will just see the date of rectification. That when did the company rectify? So from the date of rectification, wait for 5 years. After that, you can accept more deposits. Okay. So in simple words, guys, when it comes to deposits, the 5 years time limit is not from the end of the financial year of rectification. No. Instead, the 5 years time limit is from the date of rectification. Okay. Simple point. Don't forget. All right. Then listen to my next point, tenure of deposits. Simple point, guys. Generally, the tenure of deposits, it should not be less than 6 months. It should not be more than 36 months. But however, the company can accept deposits for short-term requirements also. In that case, it can be even less than 6 months. That is, it can be 3 months to 6 months. So generally 6 months to 36 months. But for short-term requirements, company can accept even 3 months to 6 months also the company can accept. But if the company is accepting deposits for short-term requirement, maximum how much can the company accept for short-term requirement? 10%. 10% of paid up share capital plus free reserves plus securities premium. Okay. Then comes the next point, guys, deposit repayment reserve. Very simple point. 20% of the deposits which are maturing, that much amount, the company has to transfer into a separate bank account in a scheduled bank. That account will be called as a deposit repayment reserve account. This transfer has to be done by 30th April. How much? 20% of the maturing deposits. Okay. The money which the company has put into this bank account, that money can be used only for one purpose, and that is for repayment of deposit. It can't be used for any other purpose. Simple, guys. But a very important point over here is that this whole concept of deposit repayment reserve is not applicable to some companies. It is not applicable to private companies. To which private companies? Either the private company is accepting deposits which is within 100% of its paid up share capital plus free reserves plus securities premium. See, a private company can accept deposit only from members. So whatever deposit it is accepting, it is within 100% of paid up share capital plus free reserves plus securities premium. Then for that private company, deposit repayment reserve concept itself will not apply. Then second point, this private company happens to be a startup, guys. In such cases, for the first 5 years from the date of incorporation, for the first 5 years, this deposit repayment reserve concept will not apply. Okay. Then comes a third point, the most important point. This private company is having borrowings. It is having borrowings from 3 people, guys. It is having borrowings from banks. It is having borrowings from financial institutions and borrowings from body corporate. Now, these borrowings happen to be less than the limit. What is the limit? The limit, 2 things. 2 times its paid up share capital. So 2 times the paid up share capital or 50 crore rupees, whichever is lesser. 2 times the paid up share capital or 50 crore rupees, whichever is lesser. This is the limit. So the borrowings of this company is less than the limit. So if the private company comes under any of these three buckets, then in that case, for that private company, deposit repayment reserve concept is not applicable. So either the private company is accepting deposits within 100% of paid up share capital plus free reserves plus securities premium, or it is a startup company. For the first 5 years, DRR concept will not apply, or the borrowings from banks, financial institutions, and body corporates put together is within the limit. Not within the limit, I should say it is less than the limit. I'm not saying less than or equal to, I'm saying it is less than the limit. So what is the limit? 2 times the paid up share capital, or 50 crores, whichever is lesser. And one more point is there, that the company should not be having any default with respect to these borrowings. Okay, so if the private company comes under any of these three buckets, and for that private company, deposit repayment reserve concept will not apply. Alright, then comes my next point, a small tiny point, guys. Whenever the company is accepting secured deposit, company has to make a charge on the assets. The company can make a charge only on the tangible assets. It cannot make a charge on intangible asset with respect to deposits. Okay, and one more point, the value of the asset which we are giving as security, the value of the asset should be enough to meet not only the amount of deposits, it should also be enough to meet the interest on the deposits. Like for example, let us say the deposit plus interest put together is 160 lakhs, okay, but the asset value which is given as security, the tangible asset which is given as security, is worth only 150 lakhs. In that case, we will treat it as if it is unsecured deposit. There is nothing called as partially secured deposit, either secured or unsecured. When can you call it secured? Only if the tangible assets which are given as security, they are worth the amount of deposits plus interest thereon. But if the value of the asset which is given as security is less than this amount, then we will treat it as if it is an unsecured deposit, not as partially secured deposit. Okay, and don't forget, only tangible assets only can be given as security for secured deposits. Okay, then comes the next point with respect to charges, section 80, guys. Once a charge is registered, from the date of the registration of charge, we will assume that every person is deemed to have notice of the charge. It's a legal fiction, guys. The law is creating an assumption over here. The law is making an assumption over here that every person is deemed to have notice of the charge, but from when? From the date of registration of the charge, not from the date of creation of the charge, guys. It is from the date of registration of the charge. So section 80, deemed notice of the charge. Once a company or the charge holder, whoever, once a charge is registered, from that day onwards, we will assume that everybody has notice of the charge, constructive notice, deemed notice of the charge. Okay, then two important points with respect to minutes I want to discuss with you. Point number 1, minutes book has to be maintained not only for meetings, it also has to be maintained for postal ballot, guys. So whenever we are maintaining minutes book with respect to postal ballot, in that minutes book we have to write 3 extra things. Number 1, a brief report on the resolution which we have passed through postal ballot, then result of the voting, that is whether the resolution is passed or not passed, and a summary of the scrutinizer's report. Okay, so with respect to the postal ballot minutes, 3 extra points will be written. Number 1, a brief report of the resolution, result of the voting, and summary of the scrutinizer's report. And minutes have to be entered in the minutes book within how many days, guys? Within 30 days from the date of passing the resolution. For minutes of meetings, we say 30 days from the date of meeting, but for minutes of postal ballot, it is 30 days from the date of passing the resolution. Okay, this was a special point with respect to minutes book relating to postal ballot. All right, then who is going to sign the minutes book? If it is board meeting minutes book, board meeting minutes have to be signed by the chairman of the meeting or by the chairman of the succeeding meeting. But if it is general meeting minutes, then that has to be signed by the chairman of the meeting. In case he is unable to sign, or in case he died before signing, then in that case a board of directors will have to authorize some director for this purpose, and that director will sign. Which means we can't go to the chairperson of the next meeting. No, we can go to the chairperson of the next meeting only for board meeting minutes. But for general meeting minutes, either the chairperson of that meeting, or if he is unable to sign, then the board of directors will authorize one director for this purpose, that director. Okay, but however, if it is postal ballot minutes, what do we know about postal ballot minutes, guys? We know that generally the minutes have to be put into the minutes book within 30 days from the date of the meeting. But postal ballot, there is no meeting itself. So that is why here the minutes have to be prepared within 30 days from the date of the resolution. Okay, now general meeting minutes have to be signed by whom? By the chairperson of the meeting. But in postal ballot, there is no meeting itself. So there is no chairperson of the meeting. So in postal ballot minutes, the minutes have to be signed by the chairperson of the board of directors. In case he is unable to sign, then we will go to the director who is authorized for this purpose. Okay. Are you noticing the tiny differences? In postal ballot, there is no meeting itself. So therefore, we can't say chairperson of the meeting. It is chairperson of the board of directors. In general meeting, here the signature will be the signature of the chairperson of the meeting. Okay, general meeting minutes have to be prepared. They have to be put into the minutes book within 30 days. Within 30 days of the meeting. The postal ballot minutes, there is no meeting over here. So it has to be put in the minutes book within 30 days of the resolution. Okay, then another point with respect to your management and administration chapter with respect to AGM. See, you know very well that the AGM will be called by the board of directors either on its own, or the AGM will be called by the board of directors upon the requisition of members. You know that how many members have to request, even that, you know guys, members put together who are holding at least 1/10 of the paid up share capital have to submit the requisition. Only then the board will call the AGM upon the requisition of members. Right guys? Now let's take an example. Let's say there are total 40,000 equity shares in the company. So members put together who are holding at least 1/10 of these 40,000 shares, that is, members put together who are holding at least 4,000 shares, they have to submit a requisition to the company, guys. It can be one person, two persons, three persons, how many ever, doesn't matter. But put together they must be holding at least 4,000 shares. Okay. Now what happened is A and B, they were joint shareholders in the company, and put together they were holding 5,000 shares. 5,000 shares, guys, which is more than 4,000 shares. So the requisition was made by shareholders holding 5,000 shares. The requisition was made by shareholders holding at least 1/10 of the paid up share capital. Therefore, now the board must call the AGM within 21 days. So basically over here, the point I'm trying to convey to you is, just because the shareholders are joint shareholders, it will not make any impact on your answer at all. The matter of fact is, the requisition has to come from shareholders who are holding at least 4,000 shares. Here together they are holding 5,000 shares, which is at least 4,000. That's all. Now board has an obligation to call the AGM within 21 days. Okay. This was your 18th point. Then coming to my 19th concept, e-voting. Extremely important from the point of view of your examination today, guys. High probability of you getting a question from here, section 108. See, the e-voting facility has to remain open for minimum 3 days. It has to be open for minimum 3 days, and it has to close on the preceding day 5 p.m. You have to understand this computation very nicely. Let's take an example. The meeting date is 14th August. Okay, 14th August 2025 is when the meeting is going to be held. Okay, so first of all, when will the e-voting facility close? It will close on the preceding day. Preceding day means what? 13th August 2025. It will be closed sharp 5 p.m. It has to be closed. Okay, and now tell me, it has to remain open for how many days? It has to remain open for minimum 3 days. See, 5 p.m. calculation everybody knows, but it is a 3 days calculation which is really interesting. How to calculate 3 days? See, it has to remain open for minimum 3 days. 13th August 2025, it is anyways open. So 13th August becomes one day, 12th August second day, 11th August third day. So 11th August 2025 to 13th August 2025, this becomes 3 days, guys, when the e-voting facility is open, 11th, 12th, 13th. And on this 13th 5 p.m, the e-voting facility will be closed. Okay, so you understood how I calculated the 3 days point, right? So this was the first point under section 108, that the e-voting facility will remain open for minimum 3 days, and it has to be closed on the preceding day 5 p.m. Okay, then comes the second point, scrutinizer. See, in 3 places in your syllabus, scrutinizer concept we talk about. Number 1, postal ballot. Number 2, e-voting over here. And number 3, postal ballot. These 3 places. Okay, now scrutinizer plays an important role in section 108. Let me give you some background revision first. See, when it comes to remote e-voting, is there a general meeting also over here? Yes. When it comes to remote e-voting, what happens is, we are giving the shareholders an opportunity, we are giving them an option that if they want, they can vote electronically from home itself, no need to come to the meeting. But in case they are not able to vote electronically from home, then they can come to the meeting and they can vote at the meeting also. At the meeting, the voting will happen either by way of poll, or at the meeting, the voting will happen through electronic means, e-voting. At this meeting, the voting cannot happen by way of show of hands. You know about this, guys? Show of hands concept itself is not applicable to e-voting. It is also not applicable to postal ballot. So e-voting and in postal ballot, in both, show of hands concept is not applicable. So once again, when it comes to e-voting, we are giving an option to the members. Option 1, they can vote electronically from home itself. Option number 2, if they're not able to vote from home, they can come to the meeting and they can vote at the meeting. But at the meeting, the voting will happen either by way of poll or it will happen electronically. Okay. Now, so which means we will have two sets of votes now. We will have set 1, those votes which were cast through electronic voting, through remote e-voting by members from home itself. That is one set of votes. Second set of votes, now the members, some of them have put the vote at the meeting. So we are having two sets of vote. Now the scrutinizer will sit and count both the sets of votes. The law says very clearly, he should first count the votes which were cast at the meeting. These votes, guys, which were cast at the meeting, only then he will count the votes which were cast through remote e-voting. But remote e-voting, preceding day 5 p.m, we locked it. So it has to be unblocked now. That unblocking will happen in the presence of at least 2 witnesses who are not the company's employees. Okay, this was the second point. So your first point was e-voting facility will remain open for minimum 3 days. It will close on the preceding day 5 p.m. Second point was scrutinizer will first count the votes which were cast at the meeting. Then only he will count the votes which were cast through remote e-voting. For that, he has to unblock the e-voting. That unblocking will happen in the presence of at least 2 witnesses who are not the employees of the company. Okay. Then comes the third point. To conduct the whole e-voting process, scrutinizer can take assistance of a person. Which person? That assistant should not be an employee of the company and he should be well versed with the e-voting system. Okay. Third point, scrutinizer can take the assistance of a person who is not an employee of the company and is well versed with the e-voting system. Point number 4, when the company is conducting e-voting, in those cases there is a general meeting also. So company has to give notice for the meeting, guys. That notice of the meeting not only will be sent to each shareholder, company also has to give a public notice. So that is, in simple words, the notice has to be given as an advertisement in one vernacular newspaper having wide circulation in the district where the RO is situated and in one English newspaper. When? After dispatching the notice to the members, but at least 21 days before the meeting. So, got it? When the company is doing e-voting, there is going to be a meeting also after the e-voting. So, for that meeting, anyways, company will send the notice. Now, that notice, the company will not only send to the members, that notice also has to be given as an advertisement in 2 papers, one English newspaper and one vernacular newspaper, when? After dispatching the notice to the members, but at least 21 days before the general meeting. Okay, so these were 4 extremely important points with respect to e-voting from which you can get a question today. Alright, then comes the next point with respect to annual return. You know very well, annual return has to be filed with the ROC within 60 days from the date of the AGM, guys. But however, please remember, if the AGM is adjourned, in those cases 60 days will be counted from the date of adjourned AGM, not from the date of the original AGM. 60 days will be counted from the date of adjourned AGM. This might be a new point for many of you. Then comes my next point about foreign registers. The company, it's an option. Foreign registers are not mandatory. Company has an option. If it wants, it can maintain a foreign register outside India. In those cases, the company has to inform ROC about 3 situations. When the company opens a foreign register, company should inform ROC within 30 days. Then when the company changes the situation of foreign register, again the company has to inform ROC within 30 days. When the company discontinues the foreign register, then also the company will have to inform ROC within 30 days. And mind you, when the company discontinues the foreign register, what will happen to the entries in the foreign register? Either they will be transferred to some other foreign register of the company, or it will be transferred back into the principal register in India itself. Right, guys? So when it comes to foreign registers, 3 situations we have to inform ROC. Number 1, when we open the foreign register. Number 2, when we change the situation. And number 3, when we close the foreign register. When we close the foreign register, whatever are the entries in the foreign register, either they will be transferred to some other foreign register of the company, or they will be transferred back into the principal register in India. And in all the 3 places, the time limit is 30 days, guys. But however, be careful. Whenever the company makes an entry in the foreign register, within 15 days, a copy of that entry has to be transmitted to India. So for this, the time limit is 15 days. When the company has to inform ROC, for that the time limit is 30 days. But when the copy of the entry has to be transmitted to India, for that the time limit is 15 days. Be careful. I have 2 sets of time limits with respect to foreign registers. Okay. Then another point with respect to quorum. In case of quorum of adjourned meeting. See, in the adjourned meeting, do we need quorum or not? It all depends upon why was the earlier meeting adjourned. If the earlier meeting was adjourned because of lack of quorum, then in the adjourned meeting we don't need quorum. How many ever members are present, we will assume that itself is quorum and we'll continue with the meeting. But if the earlier meeting was adjourned because of some other reason, like let's say there was no time to discuss some matters and for that reason the meeting was adjourned, or let's say there was a lot of commotion in the meeting and that is why the meeting was adjourned. So if the meeting was adjourned because of some other reason, then in the adjourned meeting also I need quorum. Within 30 minutes of the appointed time, within half an hour of the appointed time, I need quorum. If I don't have quorum within 30 minutes, again adjourn the meeting. Understanding? So in adjourned meeting, do you need quorum or not? It all depends upon why was the earlier meeting adjourned. Alright. Then another extremely important point with respect to interim dividend. This will be a new point for many of you. This point is from your mock test paper, guys, your September 25 mock test paper only. See, when it comes to interim dividend, we know that it may be declared out of surplus in the P&L account, or it can be declared out of the profits of the financial year, or it can be declared out of the profits of the financial year till the preceding quarter, guys. Three options company has. Either the company can declare interim dividend out of surplus in P&L account. This generally the company does when it does not have profits in the current year. In those cases, it can take profit, it can take money out of surplus in the P&L account, or the company can declare interim dividend out of profits of the financial year or out of the profits up to the preceding quarter. Okay, but however, doesn't matter which bucket or doesn't matter which category, doesn't matter which of the three things the company is doing. In all the three, the common point is before the company can pay this interim dividend, before that depreciation has to be provided for the entire year. Alright, like for example, let us say there are totally 4 quarters in the year, guys. So April, May, June. April to June will become the first quarter, and July, August, September. July to September is the second quarter, right? Let's say these 2 quarters are over. In the month of October, the company is declaring interim dividend. Company is declaring interim dividend by taking money out of profits of the preceding 2 quarters. Okay, company can do that. Basically, the third point, company is declaring interim dividend out of the profits up to the preceding quarter. Okay, now when the company is declaring interim dividend in October, before the company pays its interim dividend, company has to provide for depreciation. The question is, will the company provide for depreciation for only these 6 months, or will the company provide for depreciation for the entire year? The law says that it has to be provided for the entire year and not proportionately for any fraction of the year. So even though we are declaring interim dividend in the month of October, still depreciation has to be provided for the entire 12 months, guys, for the entire year April to March. Understanding? This might be a new point for many of you. I'm hoping you've understood properly. So whether it is final dividend, whether it is interim dividend, before we pay the dividend, before we declare the dividend, we first have to provide depreciation for the entire year and not for any proportion, not for any fraction of the year, no, for the entire year. Okay, then comes the next point, guys. Listen carefully. In case current year the company has made a loss, which means current year profits are absent, or if the current year the profits are inadequate, in those cases to pay final dividend, company can take money out of free reserves. But maximum how much money can the company take out of free reserves? We have a limit. The limit depends upon 4 conditions. Condition number 1 is that the maximum rate of dividend in such cases can be the average of how many years? Average of the last 3 preceding financial years. But this condition will apply only if the company has declared dividend in these 3 preceding financial years. If the company has not even declared dividend in all of these 3 preceding financial years, then this condition 1 itself will not apply. Then the second condition and the third condition, I will combine them together for you. These 2 conditions put together say that maximum how much amount can you take from the reserves? Maximum amount will be 1/10 of the paid up share capital plus free reserves. But from this 1/10 number, you should subtract the current year loss. Okay. And then condition number 4, you have the pot of free reserves. From that, you have withdrawn some money. Now, after withdrawing, you're still going to be left with some amount, guys. That amount which you're still left with in the reserves has to be minimum 15% of the paid up share capital. Okay. So, on the basis of these 3 points, you will get 3 numbers now. Condition number 1, you'll get an amount. Condition number 2, 3 put together, you'll get an amount. Condition number 4, you'll get one amount. So out of these 3 numbers, you will pick whichever is the least number. That will become the maximum amount which the company can take out of reserves. Okay. So if the current year profits are absent or inadequate, then the company will pay final dividend out of free reserves. So if the company is taking money out of free reserves, there's a limit. Maximum how much money can the company take out of free reserves? There's a limit. The limit depends upon 4 conditions. Condition number 1 says the maximum rate will be the average of the last 3 preceding financial years, but this condition will not apply if in all the 3 preceding financial years company has not declared any dividend. Then this condition itself will not apply. In that case only the remaining conditions will apply. Then the second and third condition we are learning together. The second and third condition say that the maximum amount which we can take from reserves is 1/10 of paid up share capital plus free reserves, but from this number we have to subtract current year loss. Okay, then the fourth condition says from the free reserves, once you take the money, how much are you still left with? You should still be left with minimum 15% of paid up share capital. So you will have three numbers now on the basis of these three calculations. Out of these three numbers, whichever is the least number, that is going to be the maximum amount which the company can take out of reserves. Okay, so these were your two revision points from dividends chapter. Then coming to accounts of companies, internal auditor. See, this concept of internal auditor is not mandatory in every company. It is mandatory only in 3 companies. Number one, it is mandatory for all those. Number one, it is mandatory for all listed companies. Number two, it is mandatory for all those unlisted public companies which are fulfilling at least one out of these 4 conditions. So out of 4 conditions, any one condition should be fulfilled. It is enough, guys. For those companies, internal audit will be mandatory. What are the 4 conditions? Condition number 1. The paid up share capital of the company should be at least 50 crores in the preceding financial year, or the turnover has to be at least 200 crores in the preceding financial year, or the outstanding loans and borrowings from banks and financial institutions put together should be at least 100 crores at any time during the preceding financial year, or the outstanding deposits should be at least 25 crores at any time during the preceding financial year. So I have 4 points. Out of the 4 points, any one condition also is fulfilled. Then for that unlisted public company, internal audit will be mandatory. Okay. Now see, when it comes to this internal audit, you should not only be very careful about the numbers. There's one more extremely important point which you have to be careful about, which I'll show you in this example over here. See, let us say the question is asking you, in financial year 24-25, is internal audit applicable or not? Listen carefully. One explanation you have to understand. I'm spending 1 extra minute on this internal audit because nice solid case-based MCQ is possible, guys. So listen carefully. Let's say the question is asking you in 24-25 whether internal audit is mandatory or not. Okay. So what will you do? You will see the paid up share capital number. All of these details are for the preceding financial year, right? The preceding financial year will be 23-24. So 23-24 last day will be 31st March 24. So on 31st March 24, you'll see how much is a paid up share capital. Oh, it is 40 crores only. It is not at least 50 crores. So my first condition is not fulfilled. Then you will see turnover of the preceding financial year. Turnover of 23-24 is 190 crores only. Okay, it is not 200 crores, it is less than that. So even this condition is not fulfilled. Then look at the loan. Before we come to loan, look at deposits. Deposits is 0. So even this condition is not fulfilled. But loan, they are saying in the beginning of the last year, that is we are checking whether internal audit is required or not in 24-25. But these conditions we will apply to the preceding financial year, right, which is 23-24. So in 23-24, they are saying, let's say in the beginning of this 23-24, the loan was 120 crores, but later 30 crores was repaid. So now at the end of the 23-24, only 90 crores is outstanding. 90 crores is less than 100 crores, guys. But however, the unique point, the most important point over here is that for this outstanding loans point and for the deposits point, you don't see how much is outstanding at the end of the year. Instead, the words used is at any time in the preceding financial year. So at any time in the preceding financial year, tell me, in 23-24, at any point of time, was the loan at least 100 crores? Yes. In the beginning of the year, it was 120 crores. It was at least 100 crores. So this condition is fulfilled. Hence, internal audit is applicable. You're understanding? The loans point and the deposits point, you will see at any point of time in 23-24, at any point of time was a loan at least 100 crores, at any point of time was a deposit at least 25 crores. Okay, like here if you see at the end of the year, loan is only 90 crore outstanding. 90 crore is less than 100 crore, doesn't matter. At any point of time in 23-24, was the outstanding loan at least 100 crores? Yes. In the beginning of 23-24, it was 120 crore. Later we repaid. So in the beginning it was at least 100 crores. Therefore this condition is fulfilled. Hence internal audit will be mandatory for this company. Okay, be careful about this point. All right. And lastly, internal audit is also applicable to private companies. Those private companies which fulfill this point B or point C. That is, they either fulfill the turnover criteria or the loans and borrowings criteria. Okay. Then comes my next point with respect to financial statements. Be careful. See, we can't straight away sign the financial statements. First, the financial statements have to be approved. First, they have to be approved by the board of directors in the board meeting. Only then they have to be signed. Only then they will be sent to the auditor for the purpose of audit. Okay. Now, the question is, who will sign the financial statements? See, the financial statements have to be signed by 4 people. In the first point, I have either the chairperson of the company if he's authorized by the board, or by 2 directors, out of which one of them will be managing director. This is my first point. Then second, it has to be signed by the CEO. Third, the financials have to be signed by the CFO. And lastly, they have to be signed by the company secretary. So they have to be signed by 4 people. Number 1, chairperson of the board, chairperson of the company if authorized by the board, or 2 directors, one of which will be managing director. Number 2, CFO. Number 3, CEO. And number 4, company secretary. Okay, so first remember the sequence. First, the financials are going to be approved by the board, and then they have to be signed. Signed by whom? Signed by 4 people. Number 1, chairperson, or 2 directors, out of which one will be MD, any one out of these 2. Then CEO, CFO and CS. So total 4 people will sign. Okay. Then about CSR, I have 3 extremely important points with respect to CSR for you over here. In CSR, when you're computing net profit, okay, in that net profit, you should not include 2 things. Number 1, you should not include the profit of overseas branches. In case a company has any foreign branches, profits of those foreign branches should not be included. And number 2, in the net profit, you should also not include dividend income from other Indian companies which have properly complied with CSR. So when you're computing, let's say you're computing A Limited's net profit for the purpose of CSR, you know it is supposed to be net profit before tax. That point everybody knows. But there are 2 more points about net profit. Be careful. When you're computing A Limited's net profit for the purpose of CSR, in this net profit, you should not include the net profit of the foreign branches of A Limited. Also, if A Limited has earned dividend income from other Indian companies who are properly complying with CSR, that dividend income also should not be included in the net profit. So you should take the net profit before tax, yes. You should also take the net profit before considering profit of overseas branches and before considering dividend income from other Indian companies which have properly complied with CSR. This was one special point. Another special point with respect to CSR is, in CSR you have the concept of ongoing project, right? Now ongoing project is nothing but a multi-year project. Multi-year project means I am starting this project in the current year. It will not get completed now itself. It will take multiple years for me to complete the project. But maximum how many years? Maximum 3 years. Now how to calculate 3 years? That is what I want to show you over here. Let us say we started the project on 30th September 2024, which means we started the project in financial year 24-25, guys. So now we can take 3 more years to complete it, which means 25-26, 26-27, 27-28. So are you noticing? I am ignoring the current year. I am ignoring the year in which we commenced the business. I am giving it 3 more years to get completed. That is, by 31st March 2028, this project should be completed. Okay. So multi-year project means, ongoing project means it's a multi-year project. It has a timeline of maximum 3 years. But in this 3 years timeline, I will ignore the year of commencement. I will take the next 3 years. Alright. This is about your CSR, some special points with respect to CSR. Then listen. We know that financials have to be filed with the ROC within 30 days after the AGM, guys. But in case they are not adopted at the AGM, then in that case, we will file the unadopted financials itself with the ROC within 30 days of the AGM. ROC will take them as provisional. Keyword, ROC will take them as provisional. And once we adopt the financials in the adjourned meeting, then within 30 days of the adjourned meeting, again we have to file the adopted financials. So in case in the AGM, the financials are not adopted, in such cases, we will end up going to the ROC twice. First, we will file the unadopted financials itself with the ROC within 30 days of the AGM. Then in the adjourned AGM, once the financials are adopted, again we have to file the adopted financials with the ROC within 30 days from that adjourned AGM. And be careful, when we file unadopted financials with the ROC will accept them on provisional basis. ROC will accept them as provisional. This is a keyword. This has to be there in your answer paper. Okay. Then comes my 29th point. We're entering into the auditors chapter now. There are some 4 to 5 points from this auditors chapter I want to discuss with you. First, about term of office of auditors. See, we know very well that in some specified companies, we have a limit on the term, guys. An individual can be appointed only for 1 term of 5 years. Audit firm can be appointed for 2 terms of 5 years each, after which there will be a cooling period of 5 years. Now, in this cooling period of 5 years, I cannot appoint another firm which has a common partner, right, guys? The incoming firm in this cooling period, the incoming firm should not have a common partner with the outgoing firm. Now, let us take an example. Let us say there was this firm A, B and Co. It had two partners A and B. This A, B and Co. was appointed for 2 terms. Okay. So now there is going to be cooling period. In this cooling period, I can't appoint same A, B and Co. I have to bring a new firm. Let us say I am bringing this firm B, C and Co. Here there are two partners B and C. Okay. So which means there is a common partner, guys. B is a common partner in both of these firms. So if I close my question over here, you will obviously say that BC and Co can't be the auditor in the cooling period because there is a common partner. But however, I am adding a little extra tadka over here. I am saying that this partner, Mr. B, is a sleeping partner. Okay, he is a common partner, but he is a sleeping partner in both of these firms. In AB and Co also is a sleeping partner. BC and Co also is a sleeping partner. Doesn't matter, guys. What matters is that there is a common partner, Mr. B. So if there is a common partner, that's all. Now this firm cannot be appointed in the cooling period. Okay. Whether the common partner is an active partner or a sleeping partner, that doesn't matter. The matter of fact is that we have a common partner. Because we have a common partner, BC and Co can't be appointed in this firm. BC and Co cannot be appointed in this company during the cooling period as an auditor. Okay. Then comes my next point, 30th point. See, this is about qualification of auditor. We know about disqualifications very nicely. You should also know about qualifications. Only a practicing chartered accountant can be appointed as an auditor, guys. This is fine. But what if a firm is appointed? If a firm is appointed, in that firm, only those partners who are chartered accountants, only they can sign and do the audit on behalf of the firm. Okay. So if the auditor happens to be an individual, that individual has to be a practicing CA. Simple. But if the auditor happens to be a firm, in that firm, only those partners who are chartered accountants, only those partners can sign on behalf of the firm. Okay. Let's take an example. Let's say there's a firm A, B and Co. This firm has two partners A and B, and both of them are chartered accountants, both of them. Alright. Now the audit of the company was done by partner A and by his team. The question is, can the partner B, can he do the signing of the audit report on behalf of the firm? Understanding the whole question, A, B and Co is a audit firm. This firm is appointed as the auditor of the company. Now in this firm there are two partners A and B, both are chartered accountants. It was Mr. A and his team, it was they who did the audit, but can partner B, can he do the sign? See, signing can be done by whom? If it is a firm, signing can be done by that partner who is a chartered accountant. Is B a partner of the firm? Yes. Is B a chartered accountant? Yes. So yes, he can sign. Simple as that. Which partner can sign? That partner who is a chartered accountant, he can sign. Alright guys, so this was point number 30. Come to 31 now. In point number 31, I have 3 points with respect to auditors. The first one is relating to remuneration. So remuneration of auditor, either it will be fixed in the general meeting itself. That is, either in the general meeting the amount will be fixed, like we will pay 5 lakh rupees to the auditor, or they can decide the manner in the general meeting. Like for example, in the general meeting they can decide that we will delegate this remuneration fixing work to the managing director, let the MD decide. So either the general meeting will fix the amount, or the general meeting will decide the manner in which the amount will be fixed. Like in my example, the general meeting can delegate this fixing of remuneration work to the MD and ask the MD to fix the remuneration. Even that is allowed. Okay. So this is my first point over here. Then there is no requirement for the shareholders to ratify the appointment of auditor at every AGM. We appoint the auditor for 5 years, guys. Now in every AGM, ratification is not required. The ratification concept is an outdated concept. It is not applicable anymore. Okay. And then another very interesting point, this will be a new point for many of you. Even this was a mock test paper point. The concept is, let's say we appointed A, B and Co as the auditor of the company. Okay. Now in this firm there are two partners A and B. Okay. Let's say there's a change in the constitution of the firm. Like for example, let's say B left the firm and in his place C joined the firm. So there is a change in the constitution. One partner has left, one new partner has joined. There's a change in constitution. So whenever there is a change in the constitution of the firm, we are supposed to treat it like an appointment of a new auditor. So once again we will have to file ADT1 with the ROC. Understanding? Whenever there is a change in the constitution of the firm, we will treat it as if it is appointment of a new auditor, and once again ADT1 will have to be filed with the ROC. Then comes the next point, disqualification of auditors. 3 points in disqualifications. Just wanted to give you a reminder. See, basically I want to give you a reminder of the 3 numbers, guys. So we have 3 numbers over here, 1 lakh, 1 lakh and 5 lakh, right guys? So the first 1 lakh number is with respect to securities. Neither the auditor himself, nor his partners, nor his relatives, none of them should hold any security security or interest in cash or in subsidiary of holding company. That is, none of them should be having any securities in the company, associate, subsidiary, holding, or subsidiary of the holding company. Okay, but relatives alone, they can have securities up to 1 lakh rupees face value. So 1 lakh rupees face value is not for the auditor himself, not for the partners. It's only for the relatives. 1 lakh rupees face value, up to that much securities they can hold. Okay, this is the first 1 lakh number. Then comes the second 1 lakh number. If the auditor himself or his partners or the relatives, if any of them have given guarantee to cash or subsidiary of holding company regarding repayment by some third person, if they have given guarantee of more than 1 lakh rupees, then that auditor will be disqualified. So the second 1 lakh number is with respect to guarantee. The first 1 lakh is for security, relatives. Second 1 lakh number is for guarantee. Then 5 lakh, this is for loan. If I myself or my relatives or my partners, if any of us have borrowed a loan from cash or from subsidiary of holding company more than 5 lakh rupees, then only we will get disqualified. Understanding? So for relatives, the limit is 1 lakh. The guarantee, the limit is 1 lakh. And loan, the limit is 5 lakhs. Okay. Now moving on, we have LLP Act over here, but before we come to LLP Act, wait, let me take you to companies incorporated outside India first. 2 points I have to discuss with you over here. The first point is with respect to section 380. Now, once a foreign company establishes a place of business in India, within 30 days itself, they have to file Form FC1 with the ROC, guys. This has to be filed with Central Registration Center, New Delhi. All other documents in whatever the foreign company has to file with ROC, everything else has to be filed with ROC, New Delhi. Right? This Form FC1 alone, which we file within 30 days after the foreign company establishes a place of business in India, this alone has to be filed with the Central Registration Center. Okay, this is the first point. Another point in companies incorporated outside India is section 381. Now, even foreign companies have to file annual return with the ROC. Even they have to file the financial statements with the ROC. For annual return, the time limit is 60 days from the end of the financial year, and for financial statements, the time limit is 6 months, 6 months from the end of the financial year. So both the time limits are from the end of the financial year. Annual return within 60 days from the end of the financial year, and financial statements within 6 months from the end of the financial year. Okay. Now come back to your LLP Act. The first point under LLP Act, resignation of partner. When the partner resigns from the LLP has to inform the ROC about it within 30 days. Very important, because when the partner resigns, it results in cessation of partnership interest. So when the partner ceases to be when a person ceases to be a partner, LLP is supposed to inform ROC about it within 30 days. Only when we inform ROC about it, only then the cessation is going to be effective. Okay. Then comes the next point. This is a very small, simple point, guys. One very small section 66 in your LLP Act, which says that when a partner lends a loan to the LLP or enters into any business transaction with the LLP, he has the same rights and obligations as he would have if he was not a partner. Which means, let's say a partner has given a loan to the LLP. Okay, so can the LLP say that you are my partner, so therefore I will not pay interest to you? Can the LLP say like that? No. It will be treated as if it is an external loan. If the LLP had borrowed a loan from any other person, LLP would have paid interest. So even to the partner also, LLP has to pay an interest. So if the LLP enters into any transaction with the partner, then for the purpose of that transaction, the partner will be treated like an outsider. So whatever the LLP would have done for external transactions, same thing LLP should do even over here. No partiality for partner. Okay. Then comes the next point, assignment and transfer of partnership interest. Let's say there's a partner of the LLP. He is assigning his share of profits, or he's transferring his share of profits to another person. Okay. So in that case, a partner becomes a transferor or the assigner, and this person, Mr. Blue, becomes a transferee or the assignee. So even though the partner is assigning his share of profit to Blue, still this partner, he continues to be the partner of the LLP. Just because the share of profits are assigned to Mr. Blue, Blue will not become the partner of the LLP. Blue will not have any rights in the LLP. Blue cannot participate in the management of the LLP. Blue cannot access information with respect to the transactions of the LLP. In simple words, the assignee cannot participate in the LLP. He cannot ask for information from the LLP. This person, Mr. Blue, and the LLP have no connection whatsoever. Understanding? So the assignee, yes, see, first of all, point number 1 is assignment of share of profits allowed. Yes, assignment of share of profits is allowed. The partner can assign his share of profits and losses to another person, that is allowed. But just because the partner has assigned, does it mean he is not a partner anymore? No, he is still a partner. Just because a partner has assigned, does it mean that the assignee becomes a partner? No, he is not the partner. The partner only continues to be the partner. The assignee does not become the partner. Just because the assignee has a right to enjoy the share of profits now, for that reason alone, can the assignee try to participate in the management of the LLP? No, we will not allow. Can the assignee ask for information with respect to transactions of the LLP? No, we will not allow. Okay. Then comes the next point. What if the number of partners falls below 2 in an LLP? In an LLP, if the number of partners falls below 2, okay, then in that case, we will give the LLP 6 months time to bring the number of partners back to 2. But if the LLP carries on business for more than 6 months with just one single partner, and if that one single partner, if he is aware of the fact that LLP has done business like this for more than 6 months with just him, then now he will start becoming personally liable for all the debts of the LLP, for all the LLP's obligations which are incurred after the 6 months period. Very simple point, guys, very important also. But the number of partners in an LLP, minimum 2 partners, guys. Individuals also can be partners in an LLP. Body corporates also can be partners in an LLP. So minimum we need 2 partners. In case the number of partners falls below 2, we will give the LLP 6 months time to bring the number of partners back to 2. If within 6 months the number of partners is brought back to 2, great, life as usual. But if 6 months have lapsed, still we are having only one single partner, then that one single partner, he will become personally liable for all the obligations of the LLP which are incurred after the 6 months period. But he will become personally liable like this only if he was aware of the fact that like this for more than 6 months LLP has continued with only him as a partner. Okay. This was your 36th point. So your first point in LLP was that whenever a partner resigns, within 30 days itself, LLP is supposed to inform the ROC about it, because cessation will be effective only after ROC has been notified about it. Then we learnt after this the next point, if the LLP borrows any loan or enters into any transaction with the partner, the transaction, with respect to the transaction, the partner will have same rights and obligations as any other outsider. Like if the LLP has taken a loan from the partner, we will treat the loan just like any other external loan. Okay. Then after this, we learned about assignment. Can you assign partnership rights? Yes, you can assign. Will the assignee become a partner now? No. Assigner only will continue to be partner. Will the assignee get any rights in the LLP? No. The assignee cannot participate in the management of the LLP. The assignee cannot ask for information also from the LLP. Then after this, what if the number of partners falls below 2? We will give the LLP 6 months time to bring the number of partners back to 2. If 6 months have lapsed and still we are having only one single partner, then that one single partner will become personally liable for the obligations of LLP which are incurred after the 6 months period, provided he was aware of the fact that for more than 6 months LLP has done business with only him as a partner. Okay, now listen guys, 2 more points in LLP. Let's finish off this one first. Name reservation. LLP also name reservation concept is applicable. In LLP, name will be reserved for 3 months. But in Companies Act, for new companies, name reservation is 20 days only. For existing companies, name reservation is 60 days. Right guys? In corporation, you must have learnt about all this. New company reservation, name reservation is 20 days. Existing companies, if they want to change the name, for them name reservation is 60 days. But in LLP, name reservation is 3 months. Okay, be careful about this. Now listen guys, coming to point number 37, compromise, arrangement, reconstruction. There's actually one more, amalgamation. So there are 4 points over here: compromise, arrangement, reconstruction and amalgamation. Now with respect to these 4, there are some common points. Those common points I want to give you a reminder so that doesn't matter what they ask you in the examination, those common points at least you can write. Point number 1, whether it is compromise, arrangement, reconstruction or amalgamation, doesn't matter which out of these 4, we require NCLT approval. So once we get NCLT's approval, we have to file that NCLT's approval order with the ROC. We have to file it within 30 days. If we don't file it within 30 days, then punishment. This punishment is important. Punishment is going to be 10,000 rupees. In case of continuing default, 100 rupees per day. Maximum 1 lakh for LLP, maximum 50,000 for the designated partner. Okay. First point, we have to file the NCLT's order approving the compromise, arrangement and all the NCLT's sanction order, we have to file with ROC within 30 days. Only when we file it with the ROC, then only it will become effective. Point number 2, what if we don't file within 30 days? Then punishment. Then comes point number 3, once NCLT passes the order, even after that, NCLT will still have powers. NCLT can still supervise the whole compromise and arrangement. NCLT can still give directions to modify the compromise or arrangement. So even after NCLT has passed sanction order, even after that also NCLT will have a role to play. They can supervise the process and they can give directions to modify the process. Point number 3. Then comes the last point, point number 4. Let us say we have LLP 1 which has now merged into LLP 2. Now what will happen to LLP 1? It has to be wound up, guys. So NCLT will pass an order for dissolving this LLP 1 without following the winding up process. Without following the detailed winding up process, the NCLT will make a provision for dissolving LLP 1 without winding up process. Alright guys, so with this we're done with the LLP Act also. So we're done with the Companies Act and LLP Act. Now come to General Clauses Act. With respect to immovable property, guys, I've already prepared the whole SOS video, which I'm hoping you've watched by now. The reason why I've brought it over here once again is because there are these 5 points which I forgot to discuss with you in our SOS video. 5 additional examples with respect to immovable property. Industrial warehouse, of course this will be immovable. Farm land, guys, immovable. Plantation of 200 timber trees, even this will be immovable. Soil for making bricks, this is benefit arising out of land, even this will be immovable. Then doors and windows of the house, they are attached to the earth, right? They are permanently fastened to anything attached to the earth. They are attached to the building and the building is attached to the earth. So even they will become immovable. Okay. Then comes our next discussion about computation of time. I'll explain it to you over here in a very simple manner. Listen to me. See, let us say I'm supposed to make some filing with the ROC. Okay, I'm supposed to file some document with the ROC. I'm supposed to file within 30 days. And the 30th day happens to be 13th of April 2024. On this day, the ROC office or the court, as the case may be, is closed. Now, whenever this happens, I'm supposed to do the filing on the next day whenever the office or the court opens. Now, next day is 14th April 24, which let's say happens to be a Sunday. So even on this day the office is closed, guys. So next, when is the office opening? 15th April 24. So on this date, if I do the filing, it will be as if I have filed on time. Understanding? So even though originally I should have filed by 13th April, but on this date the office was closed because of whatever reason, known public holiday, emergency public holiday, whatever reason, doesn't matter. On this date the office is closed. So whenever it reopens again, on that day if I go into the filing, it is as if I have filed on time. Okay. Then comes the next point, from and to. You know this very well. When we use the word from, we exclude the first day. When we use the word to, we include the last day. From, exclude the first day, to include the last day. Then if you commit an offense which is punishable under 2 enactments, then trial can be done under both the enactments. Trial can be under both the enactments, but punishment will be given only under one of the enactments. Which one, the court will decide. Okay, you can't be punished twice for the same offense. If the same offense is punishable under multiple enactments, then trial may be under both the enactments, but punishment will be only under one of the enactments. Then you know this next point also very well, financial year and calendar year. When the law uses the word year refers to calendar year as per British calendar, Jan to December. Financial year is April to March, and month is month as per the British calendar, Jan, Feb, March. Okay. Now coming to FEMA, extremely important point, guys. There is a PRI, person resident in India. He is having some foreign currency or some foreign security or some immovable property outside India. He can continue to HOTI. He can continue to hold, own, transfer, invest. He can continue to HOTI. Okay. Understand this a little better with the help of the RBI circular. RBI circular says 4 transactions are covered. Let's take an example. Today I am a PRI, but earlier I was PROI. That time I had a foreign currency account. I can continue to maintain that account. I can continue to use the money in that account outside India, no problem. No RBI approval required. Point number 2. Today I am PRI, but earlier I was a PROI. That time I was doing a job outside India, for example. I had earned salary outside India from that job. I still have that salary money with me. I can continue to use it without RBI approval, no problem. Third point, today I am PRI, but earlier I was a PROI. That time I had made some investments. From those investments, I am today getting some income outside India. I can continue to utilize that income. I don't require RBI approval. Today I am a PRI, but earlier I was a PROI. That time I received some gift or inheritance. From that I am getting some income now. I can continue to utilize that money, no need of any RBI approval. Or I had acquired these assets earlier when I was a PROI, or I had inherited these assets from a PROI. All these assets become eligible assets, guys. The PRI, today I'm a PRI, right? I'm having these eligible assets abroad. Income from these assets, sale proceeds of these assets, I can freely utilize without any RBI approval. I must just ensure I follow the FEMA provisions and I don't use this money for prohibited transactions and all. Apart from that, no RBI approval is required. I can freely utilize. Understanding? Today I'm a PRI. I'm having some foreign currency, foreign security or immovable property outside India. Either I had acquired them earlier when I was a PROI, or I inherited them from a PROI. Now these assets become eligible assets. I can freely utilize these assets. I can freely utilize the income from these assets. I can freely utilize the sale proceeds of these assets without getting any RBI approval. Okay. Then very important reminder with respect to residential status of an individual. If an individual comes to India for three purposes, you know the three purposes. He's coming to India for employment in India, or he's coming to India for business in India, or if he's coming to India for any other uncertain period, then if he's coming to India for three purposes, I don't care about 182 days criteria. I will straight away call him as a PRI. Similarly, if an individual is leaving India for these three purposes, I don't care about 182 days criteria. I will call him as PROI. If you come to India for these three purposes, PRI. If you leave India for these three purposes, PROI. In these cases, 182 days criteria is irrelevant. Then, this point was there in the mock test paper, guys. Might be a new learning for some of you. If you're going to receive advance payment from foreign buyers, it's going to be freely permissible current account transaction. Let's say you have to sell some goods, you're trading in goods, you're getting advance payment from foreign buyers. It's a freely permissible current account transaction. Okay. Now entering into a last chapter, interpretation of statutes, I have four concepts for you over here. First one, grammatical interpretation. Grammatical interpretation, listen to me carefully. Courts must accept the letter of the law as the exclusive and conclusive evidence of the spirit of the law, which means whatever is written in the law, the words of the law, with that only we are supposed to interpret the law. So the court must accept, be careful about the language, court must accept the letter of the law as the exclusive and conclusive evidence of the spirit of the law. Normally, grammatical interpretation is the only approach to be adopted. Court cannot take from or add to or modify the letter of the law. In simple words, guys, grammatical interpretation is giving the highest weightage possible to the letter of the law. That is, this grammatical interpretation is saying, read what are the words written in the law, and with that try to find out the spirit of the law. Read what is written in the law, and with that try to find the intention of the lawmaker. Spirit of the law is nothing but intention of the lawmaker. Letter of the law is nothing but the words which are written in the statute. So grammatical interpretation, main point is this only, that if you want to find out the meaning of a particular law, if you want to find out the meaning of the provision, understand the meaning of the provision from the words which are written in the statute. The court cannot modify the words. Whatever words are written in the statute, with those words the court has to interpret the meaning of the particular provision. But however, there are three exceptions, A, I, R. If the words are ambiguous, or if the letter of law is inconsistent with the intention of the lawmaker, or if the text is leading to an unreasonable interpretation, in these cases the court can depart from the letter of the law. That means a court can ignore the words and logically try to find the intention of the legislature. So generally, full focus, full weightage is given to the letter of the law. But in AIR cases, that is, if the letter of the law is A for ambiguous, or I for inconsistent, and R for unreasonable. If the letter of the law is ambiguous, inconsistent or unreasonable, in these three cases we can depart from the letter of the law and logically try to find the intention of the legislature. Okay, this is grammatical interpretation, important. Now coming to the next point, guys, Hayden's rule, which is also called as a mischief rule. Now we apply the Hayden's rule only in those cases where more than one interpretation is possible, that is, multiple interpretations are possible. Okay, in such cases we are supposed to look at four things. Number one, what was the earlier law? Then what was the mischief or defect defect or hardship in that earlier law, then how does a parliament seek to resolve or cure the mischief, and what is the reason for the remedy? So on the basis of these four things, multiple interpretations are possible, right? So on the basis of these four things, we will choose that interpretation which suppresses the mischief and advances the remedy. This is a Hayden's rule filled with keywords. This is when do we apply this rule? Only when multiple interpretations are possible. In those cases, we are supposed to look at four things. Number one, what was the earlier law? What was a mischief or defect or hardship in that earlier law? Then how does a parliament seek to resolve or cure the mischief? And what is the reason for the remedy? On the basis of these four things, we are supposed to choose that interpretation which suppresses the mischief and advances the remedy. In simple words, what this means is that when multiple interpretations are possible, we should choose that interpretation with which we will be able to meet the objective of the law. I'll repeat again. If multiple interpretations are possible, we are supposed to choose that interpretation with which we will be able to give effect to the objective of the law. Like for example, Workmen's Compensation Act. The whole objective of this act is to provide compensation to workmen. So if when I'm reading this particular statute, wherever multiple interpretations are possible, I will choose that interpretation with the help of which I will be able to meet this objective of providing compensation to workmen. Understanding? So when multiple interpretations are possible, you will choose that interpretation with which you will be able to meet the objective of the law. You will choose that interpretation with which you will be able to give effect to the objective of the law. Okay. Then comes my 49th point, preamble. Preamble expresses SOP, scope, object and purpose of the act. It is a part of the act. It is an internal aid. It is a main source to understand the primary intention of the lawmaker. If you want to know why exactly has the lawmaker made the law, you will go and look at the preamble. You will get to know the intention of the lawmaker. So it expresses SOP, keyword. It expresses scope, object and purpose of the act. It is a part of the act. It's an internal aid. It is a main source to understand the primary intention of the lawmaker. When do we refer to the preamble? We refer to the preamble in those cases where the words of the statute gives rise to doubt. When multiple interpretations are possible, when more than one meaning is possible and a doubt arises as to which meaning is intended, we go and refer to the preamble. So we refer to the preamble when the wording of the statute gives rise to doubts. Basically, when we are reading the law, if there is no ambiguity, if everything is pakka clear, I will not even look at the preamble, guys, but I will come to the preamble only when there are doubts. Then I will come to the preamble. When I read the preamble, I will get to know the intention of the lawmaker. With that, I will be able to interpret the law. Okay, but very important, remember, the preamble does not override the plain provisions of the act, which means if the preamble and some provision of the act, if they are conflicting between these two, which of the two will you give priority? The provision and not the preamble. The preamble cannot override the plain provisions of the act. Okay, then comes my last point, dictionary definition and external aid. See, whenever we want to interpret the law, we will first try to find the interpretation with the help of internal aids. If the internal aids are not helpful, then we will come to the external aids. One of the external aids is dictionary definition. But you can't straight away come to the dictionary definition. First, you have to see the act itself, whether the act itself is giving you the meaning of the word or not. First, you have to give preference to the act. If the act is not giving you the meaning of the word, then you will check, is there any judicial decision with which you can find the meaning of that particular provision. So if the meaning of that particular word is not given in the act also, and also if there is no judicial decision which is explaining the meaning of that particular word, then only you can refer to the dictionaries. You can refer to the dictionaries to find out the general sense in which that word is commonly understood. But when we are referring to the dictionary, we should also keep in mind the context in which the word is used. And finally, if it's a technical word, we must make use of technical dictionaries. Okay, but keep in mind the sequence. We will always first try to refer the act. We will try to find the meaning of that particular word from the act itself. But if we are not able to get the meaning over here, then we will check, do we have any judicial decisions which lay down the meaning of that particular word. If we don't have any judicial decisions also, only then we will go to the dictionary. And when we go to the dictionary, we should always keep in mind the context in which the word is used. Okay, so that is it, guys. These were those 50 concepts that I wanted to discuss with you on the day of the exam, because I'm so sure something or the other from here you will find in the question paper in some form or the other, either in MCQs or in the descriptive part, somewhere or the other. I'm hoping some part of this you will find, and this 1 hour which you've spent with me on this video, it's going to benefit you in ways you can't imagine right now. All right, guys, that's it. With this, I think we are done with our preparation for law. Whatever leftover time you have, you might still have a lot of concepts left. Okay, it's okay. Try to just glance through as much as you can, and when you walk into the examination hall, walk in with the confidence of a winner, because when you come out of the examination hall, you are going to come out smiling. All right, guys, all the best.